Investing in real estate is probably the single most tax-friendly way to make money if you don't completely screw it up. In this video, I'm going to tell you the 4 ways that most real estate investors completely lose out on all the tax benefits that real estate should provide to them. And I'll show you the strategies you need so you can avoid those mistakes and avoid paying thousands of dollars more in taxes than you need to. I'm a CPA that saved hundreds of business owners and real estate investors collectively over $10 million in taxes. But before I dive into the mistakes most real estate investors make, what makes real estate investment so tax-friendly in the first place? You get a massive business expense that does not require you to spend additional cash, called depreciation. So the earnings from your real estate that you report on your tax return can be significantly less than the amount you actually earned. But too many real estate investors have no idea how to maximize the benefit of it. So what even is depreciation? Depreciation is the amount you write off against an asset over time to reflect its decreasing value. Now, most of the time, real estate is not going to decrease in value. In fact, it usually goes up in value significantly. But you can account for it as if it does go down in value, and as such, claim a huge expense on your tax return. Let's give an example. Say you bought a single-family home for $750,000 and wanted to turn it into a rental. You very well may be renting it out at $4,000 to $6,000 a month. For simplicity, let's say after paying property taxes and some other expenses, you end up with $45,000 in profit for the year. Well, you're not going to pay taxes on $45,000 worth of income. Right off the bat, you get a depreciation expense of around $22,000. You're reporting a profit of $23,000 and paying significantly less in taxes compared to if you made an extra $45,000 at your job or in your business. Because in addition to reporting less income, a residential rental like this is going to be treated as a passive activity, and as such, you aren't paying employment taxes of 7.65% like you do at your job, or 15.3% like you do in your business. So right off the bat, we can tell that the way real estate income is taxed is far superior to the way your other income is taxed. But how do people screw it up? Well, for starters, some people may not claim depreciation fast as they could when it would benefit them. Using that example, you aren't just limited to $23,000 of depreciation per year for the next 27 and a half years. Well, there's many different aspects of your property that you can depreciate much quicker than that. And we know that $1 today is worth much more than $1 27 years from now. So if you could save an additional $10,000, $25,000, or even $50,000 this year, imagine how much more that is worth for you after 27 years of compounding, compared to if you just saved a fraction of that on your taxes each year. So how do you take more depreciation up front? Well, starting in 2025, you can depreciate the entire cost of certain assets completely in the first year instead of over time. Some of those assets would have taken 15 years to depreciate, and instead you can take the entire cost or value as a write-off in the first year. But you can't simply write off the entire building or home as an asset. You need to separate out the assets within or outside the property and specifically identify them in order to write them off in the first year. Usually you get a professional to come in and do a study to segregate out the cost of the assets that you can write off quicker. So what kind of assets can you write off in the first year that count as separate from the building and land itself? Could be land improvements like parking lots, driveways, sidewalks, fences, gates, landscaping projects, sprinkler systems, and pretty much anything else that was an improvement to the land outside the building. It could also be improvements within the building if it's a commercial building and not residential. That includes drywall build-outs, interior doors, removable ceilings, plumbing, HVAC, electrical, and alarm systems, etc. Not to mention carpeting, flooring, furniture, and pretty much anything else that's clearly not a part of the building itself. Now, even though that money today is worth more than money in the future, that doesn't always mean it makes sense to take more depreciation up front, which leads us to the next big mistake real estate investors make: losing out and not being able to take advantage of accelerated depreciation. There's 4 scenarios in which you can take advantage of accelerated depreciation and write off real estate losses against your other income that you have. The first scenario is that you're considered a real estate professional. The IRS grants real estate professional status to anyone who spends more than 750 hours per year working in the real property industry if that work makes up more than half of the work that you do during the year. And what kind of work counts? Being a landlord, real estate agent, property manager, house flipper, all those hours would count towards you being a real estate professional. The important thing to note is that the hours you work as a W-2 employee do not count here. But most real estate agents are paid as 1099 contractors, and those hours count towards you being a real estate professional. How does qualifying as a real estate professional help you? Well, when you're a real estate professional, any property that you materially are involved in is going to be considered an active activity as far as the IRS is concerned. Now, active losses can be used to offset all other kinds of income, including W-2 income from you or your spouse, business, or 1099 contractor income you may have, or even investment income. If you have large losses on paper because you take a bunch of accelerated depreciation, you could offset all the other income you have. The second scenario that would allow you to take advantage of big losses from accelerated depreciation would be if you operate your rental property as a short-term rental. The IRS allows you to treat short-term rentals as an active activity, even if you're not a real estate professional, as long as you materially participate. To qualify, your rental would need to have an average stay of under 7 days or under 30 days if you provide substantial services. Think hotel-style services like frequent housekeeping, regular linen and towel changes, or some other services that go above and beyond a typical landlord-tenant relationship. Knowing that short-term short-term rentals qualify as active activities, meaning you can write off huge losses on these properties from depreciation, opens up a bunch of additional investment opportunities that you might not have been able to previously consider. If you were looking to acquire a property that was going to provide, say, a 7% return, and the property could function as an Airbnb that would provide an additional $10,000 to $100,000 of tax savings in the first year, it could be the difference between being an investment that provides a great return versus an investment you may not have even previously considered. The third scenario that allows you to benefit from major losses from investment properties would be if you had a bunch of other passive income. If you're someone who already invests in businesses and real estate passively, even if you're not a real estate professional, these passive losses can be used to offset passive income that you may get from K1s you invest in. Similarly, if you know that an investment property can throw off tens or hundreds of thousands of dollars in additional passive losses in the first year due to depreciation, and you no longer have to pay any taxes on your passive income, that could make or break the profitability of your rental investment. The last scenario that would allow you to benefit from rental property depreciation losses would be if you qualify for the mom and pop exclusion. The IRS allows you to offset active income with up to $25,000 of passive losses if you make under $100,000, and allows a partial offset up until you make $150,000. So for small-time investors with their first investment property, you still may be able to benefit from large depreciation losses. However, not everyone is going to be able to benefit. And that's our third big mistake that real estate investors make, trying to claim accelerated depreciation when they shouldn't be. A lot of real estate investors think they're going to get massive tax benefits from their real estate investment. Some investors flat out won't be able to use any real estate losses because they don't qualify under one of those four scenarios. Some investors still may qualify, but it doesn't actually make sense to do so. Say you know that this is going to be a low income year for you. Maybe you or your spouse expects big raises at your job over the next 5 to 10 years and are going to be in a much higher tax bracket. Maybe you plan on selling off crypto, one of your properties, or your business in a future year. Maybe you're going to be moving from a no tax state to a high tax state like California and New York in the next few years. Well, it wouldn't make sense to take a bunch of losses in a year where you're going to be in a low tax bracket if you're going to be paying taxes at higher rates in future years. That's part of effective tax planning, making sure that the deductions you take are getting the maximum benefit depending on your situation. If you're not working with a CPA to proactively help you make decisions on when you should claim losses from real estate, you could be leaving thousands of dollars on the table in tax savings. If you think you could benefit from effective tax planning, me and my team specialize in helping business owners and real estate investors save tens or hundreds of thousands of dollars in taxes. Book a call on the link in the description and I'd be happy to help you save thousands on your next tax bill. The fourth big mistake that real estate investors make is putting real estate in a corporation. Real estate should almost never be owned in a corporation for a few reasons. First, if you want to claim losses on a business or investment property, you need to have enough basis in the business or property. If you acquired a property with a mortgage and the property is in your S corporation, you could very well not be able to use any of the big depreciation losses on your tax return because you didn't have enough basis. Whereas if you simply own the property in an LLC or in your personal name, the mortgage would increase your basis and you'd have no problem using the losses on your personal tax return. Let me give you an example. Say you bought $1 million property with a business partner which you each own 50% of. Say you put down a 20% down payment of $200,000 and got an $800,000 mortgage to fund the rest of the acquisition. In this scenario, if you formed a new S corporation to buy the property, your basis would only be the amount of the down payment or 50% of the $200,000 to start. The mortgage will not increase your basis at all, and you and your business partner are each limited to taking losses of $100,000 each. Now imagine you bought the same property in an LLC with your business partner. The mortgage would increase your basis, and your basis starting out would be the amount of the down payment funded plus the amount of the mortgage you guarantee. You would each be able to write off up to $500,000 in losses. Simply putting a property in an S corporation could cost you tens if not hundreds of thousands of dollars. Here's another downside to putting a rental property in a corporation. What the wealthiest real estate investors do is essentially maximize all the tax benefits they possibly can from their properties and then either hold the property until they die to pass it on to their kids or exchange the property for a new property in a 1031 exchange in order to evade paying taxes on it. I'll touch on that in the next video of this series. If your property was held in a corporation, when your kids inherit it, they won't be able to take advantage of any depreciation that you already took advantage of. Most of the time, you probably would have used up all the depreciation. Not only that, if they go and sell the property, they'll have a huge tax bill to pay because they wouldn't have gotten what's called a step up in basis on the properties that were in the corporation. So if your properties were in a trust or an LLC, when they inherit the property, they get to step up in basis and not only get to start depreciating the property all over again, but they also can sell the property for zero gain. There's a massive difference between owning a property in a corporation and not doing so, and it could be the difference between an additional 6 or 7 figures in taxes paid by you and your family. If you're a real estate investor and aren't maximizing the tax benefits of your properties, you're simply leaving money on the table. Paying a CPA to help you plan could easily make you 5, 6, or even 7 figures simply by taking advantage of the legal tax saving strategies that are out there. Me and my team help hundreds of business owners save 6 figures on their tax bill. If you want to work with me, book a call using the link in the description. Let me know what you want to see next. Hope you enjoyed this video. If you got value, please like and subscribe. See you in the next one.